Hi everyone, thanks for being here tonight. This webinar is brought to you by Bursa Malaysia and managed by LifeChamp. My name is Satira and I'll be your moderator for today's session. Tonight's topic is about RCA. How effective is the strategy in today's stock market? All of us know the stock market can be incredibly unpredictable. One day it's up and the next day it drops without warning. That's why many investors are asking, is ringgit cost averaging or RCA still a good strategy in today's market? Or should we be looking into the cyclical trading instead? You have probably heard the saying, invest regularly and let time do this thing. But with all this market volatility, does that advice still hold up? To help us explore this, we are very honored to have Mr. Ian Tai here with us today. He'll be sharing his thought and experience on whether RCA still works in today's investing environment. Before we begin, just a quick disclaimer. Everything shared in this session is educational purpose only. We are not here to give any specific buy or sell recommendation. So please make sure to do your own research before making any investment decision. Now let me introduce our speaker for tonight, which is Mr. Ian Tai. Mr. Ian Tai is a well-known dividend investor and financial content creator. He's written over 550 financial articles featured on platforms like kclau.com here in Malaysia, and the fifth person Value Invest Asia and Small Cap Asia in Singapore. He is also the co-founder of DividendVault.com, which is an online platform that helps everyday investors build portfolios that pay growing dividends every year. On top of that, Mr. Ian also has authored three best-selling books, which is Maximizing Your Wealth Investing in Precious Metals. The second one is The Secret to Invest and Grow Your Wealth in God-Made Money instead of Man-Made Money. So, we're really excited to hear what he has to share with us tonight. Let's give a warm welcome to Mr. Ian Tai. Hi, Mr. Ian Tai. How are you doing today?
Yeah, pretty good. Thank you so much, Atira. Wonderful introduction.
Thank you.
Nice to have you introducing me. And of course, thank you so much, Shane and Stella, for organizing this session so that we can actually exchange ideas on how we can better invest, right? So let me just take it away. I'm going to just share with you my screen and we can get the whole content right away. Okay, so by the way, if you have any questions along the way, just feel free to type in your questions at the Q&A box. I'm very sure that Atira will be moderating the whole Q&A session after this whole presentation. So today we're going to talk about ringgit cost averaging, and these are the webinar outlines for today's session. The first thing that I would like to discuss is actually to give you a brief definition of RCA or ringgit cost averaging. So this one will be quite brief. And before I give you guys the definition, right, just want you guys to know how many of you are actually well versed with dollar cost averaging, ringgit cost averaging. How many of you have heard of this term? If you are one of those people who have, yes, I have heard of this term and I'm actually a practitioner of ringgit cost averaging, type in the chat box, say me. All right, just put in me. I as an indication saying that I am actually practicing ringgit cost averaging at this point in time. Okay, so just type in me if that's you. And if let's say you haven't heard about RCA, just type in no. All right. Just put in an indication in the chat box. Let me know whether or not you are practicing or not practicing RCA at this point in time. All right, thank you so much. Next, I will be doing a case study where we are going to do a back testing with one actual Bursa listed stock. So there will be a back testing session. So you may want to actually pay attention to that because it's quality content that you are receiving today. The third one that I will be talking about today is how all of us should not use RCA. And last but not least, I will leave behind two effective ways that all of us can consider using in order to enhance our practice in RCA. Okay, so let me just see the responses. So there are quite a number of you guys like Muhammad Azri, TK, uh, Tan L Hawk. All right. So Kennedy Buddha, of course, Lim Kok Chin. So you guys have heard of RCA and you guys are practicing. Fantastic. And some of you guys like CS Wang, Ronald Chong, Richie is like half-half. Richie Isaac is like half-half. And then Muhammad Azizon, no. And Hani Zulkifli, no. All right, fantastic. So this will be a fantastic session to know about RCA. Okay, number one, definition of RCA. So in order to understand DCA or RCA, it's just a difference. The difference is just the currency. So in the Malaysian context, we use R, stands for Ringgit lah, Ringgit Malaysia. So it's Ringgit Cost Averaging. So over here, there are 5 key points to note when it comes to RCA. So these 5 key points will make the definition of RCA. So we have 1, 2, 3, 4, 5. Very simple. So the first one, investment asset. The second one, investment amount. The third one, investment time period. Number 4, asset prices going up. What do you do? And asset price coming down. What do you do? Right? So the definition of RCA is as follows. Number 1, investment asset. So when it comes to investment asset, you only invest in a fixed asset. Okay, so it can be the same stock, it can be the same mutual fund or unit trust, it can be even our EPF, you keep investing back into the EPF, or it can be for real estate investors, it's the same concept. Maybe you are just buying the same kind of property, doing it again and again, all right? Maybe, let's say, for example, we have a whole condo, although the size is not exactly the same, but then you keep on accumulating units within that condo building. So it's like, in a way, kind of like DCA, all right? So what you do is that the general idea is that you fix an investment asset to invest in. So in the case of stock investing, it has to be the same stock, all right? So that's the first one. Now, the second one would be the investment amount. So the investment amount is also fixed, which means say every time you invest in that same stock, you also invest almost the same amount. Okay, same stock, same amount. Now the third one is actually investment time period. So investment time period, you kind of like also fix it up, which means to say you don't actually practice market timing. You don't try to time the market here and there. You just have a set time. You fix it, like you preset it. Like it can be like every year you buy this stock once at a certain date. Let's say 31st December. Every 31st December or every 31st December, you kind of like give yourself a New Year gift and you buy yourself a certain stock. Must be the same stock at the same amount of investment, same date. So everything is the same. Investment asset same, investment amount same, investment time period also quite fixed. It can be 1 year once, it can be every 6 months once, it can be every 3 months once, or it can be every month once. All right. So it has to be at the same time period. Now, when you do that, certainly in terms of stock investing, the prices can go up and down. So if let's say the stock price goes up, because you're going to invest in the same amount of, your investment amount is the same. So when the asset price goes up, you tend to buy less units. And if let's say the stock price comes down, because you kind of like fix your investment amount, you're going to buy more units. So that is actually the definition. Now, how many of you have a picture on what RCA is? Put in yes if you're one of those who have an idea already. If let's say after this whole explanation, you say, I still don't have an idea, type in, no, I don't have an idea yet. right? Just put it in the chat box, let me know. Okay. All right, fantastic, guys. So without further ado, let's go into the second part, which is the back testing. Okay. So most of you guys kind of like know what RCA looks like already. But the question is, how does it look like in practice? So here we're going to do a back testing. And in order to do a back testing, right, we need an actual stock. So here I'm going to just pick one of the stocks that I believe is suitable for this case study lah. And the stock that I picked for this back testing, right, is Carlsberg Brewery Malaysia Berhad. Okay. So this is the stock that I will be using for the purpose of back testing. Okay, so in order to do this, let us kind of like imagine ourselves putting ourselves back to 2015. So I know right now, as I'm speaking, it's 2025, but now let's just rewind ourselves 10 years back to 2015. Now in 2015, okay, let's say we teleport ourselves back to 2015. At 2015, what happened is that as an investor at that time, you will have access to the accounts of Carlsberg Brewery Malaysia Berhad all the way up to 2014. Okay, so you're investing in 2015. So you have all the annual reports, quarterly reports up to 2014. And then from there, you study the accounts and then you kind of like plot a graph like this. So this is an earnings graph. And what you can see is that this is the earnings reported by Carlsberg Malaysia, over the past 10 years up to 2014. So we can see that Carlsberg has kind of like flat profits over here, around 88 million. And then over here, about 70 plus million. And then boom, it hits 211.6 million. So this is actually the case for Carlsberg lah. All right. This is the earnings for Carlsberg Malaysia. All right. So because of the earnings growth of the company, and because Carlsberg is beer business let's assume that at that time, back in 2015, you believe in the company, you hope that you want to RCA this company. Let's assume, for the sake of this webinar session. So let's RCA this Carlsberg Brewery Malaysia, this stock. Okay. Now, so this is actually the period. Take a look at this same earnings graph over here. So the blue line over here represents a period of time before your RCA. So blue color is before you invest. Red color is a period of time after you start investing, after you start RCAing Carlsberg Malaysia. So this is what happened to its earnings. So over time, it has grown, except for these 2 years lah, because it was impacted by COVID. Okay, so at this point, guys, type in the chat box. Take a look at this earnings graph over here. So put it in the chat box. How many of you would say that if you can turn back time to 2015 and you start RCAing Carlsberg Malaysia, and this is actually the financial results. This is the earnings that Carlsberg has delivered over the next 10 years, starting from 2015. All right, over the next 10 years. How many of you are happy with this financial results? How many of you are happy with this earnings generated by Carlsberg Malaysia? If you're happy, put it in the chat box, type in happy. Let me know in the chat box if you're happy with this financial results. All right. So Ronald Chong says yes, happy. Nick Amira, happy. Yo, happy. Kennedy Budak, happy. All right. Thank you so much. All right. Let's move on. Now, this is how we do the back testing for Carlsberg. So investment asset, we are going to fix it at Carlsberg. The investment amount, we are going to just say fix around 10,000 ringgit per investment, which means every time you buy or every time you invest Carlsberg, it's going to be 10,000. Every time, 10,000, 10,000, 10,000. Okay. Investment time period. For this back testing, we are just going to make one investment only. one investment per annum, 1 year once, at this date, 31st December. Okay. So every 31st December, 10,000 ringgit, Carlsberg. Okay. So it doesn't matter what price. If let's say the price it happens to be higher, then you buy lesser units. If Carlsberg, the price of Carlsberg comes down, then you buy more shares of Carlsberg. So that is actually the game plan. So how it looks like, this is how it looks like. So which means to say on the 31st December 2015, you intend to invest around 10,000 ringgit. The stock price of Carlsberg at that time was 11 ringgit 70 cents. So if you take 10,000 divided by 11 ringgit 70 cents, the exact share amount would be 854.7 shares. However, because we are investing in Malaysia, every single time we buy a stock, we have to buy in a multiple of hundreds. So you cannot buy 54.7 shares. You either buy 800 shares or you buy 900 shares. Okay. So in this case, let's just round it up. So actually exactly you want to buy 854, but you can't buy 854, so we buy 900 lah. Okay. So 900 times 11 ringgit 70 cents. So you ended up investing 10,000 ringgit, 10,530 ringgit. Okay. So you just plus minus lah every single year, just so that you can round out to the closest 100 shares. Okay, at this stage, how many of you understand what I'm saying here when it comes to this transaction? If you understand, just type in the chat box, say yes. Okay, thank you so much, Muhammad Azri. And with that, let's continue. Now, 1 year has passed already. 1 year has passed. Now we are at 31st December 2016. Once again, because you are DCAing, or should I say RCAing Carlsberg Malaysia, you are going to invest another 10,000. But this time round, the stock price of Carlsberg Malaysia has appreciated to 13 ringgit 92 cents. And because of that, the exact share amount will be 718.4 shares. But you can't buy 718.4 shares. So you round it up to the closest 100, which is 700 shares. So therefore, your exact investment amount will be 9,744 shares. Okay. Now, what you're going to do is that you're going to repeat this kind of thing. 2015 done, 2016 done, 2017, 2018, 2019, 2020, all the way up to 31st December 2024. Now, this will be the exact investment amount that you are going to invest. So initially, you have 10,530 ringgit. The following year, 9,744 ringgit. The following year, 10,710 ringgit. Then you add up this. So in total, you have made 10 transactions. 10 times you invest. The total invested amount would be 98,102 ringgit. Okay, 98,102 ringgit. So it's close to like 10 times 10,000, very close to 100,000 lah. Okay. Now, from this capital, the invested amount, 98,102 ringgit. How many shares have you acquired? So in total, during the 10-year period, you have acquired 5,400 shares. Okay. Now, if you take this amount, divide by this amount, which is 5,400 shares, your average cost per share would be 18 ringgit and 17 cents. All right. So this will be the average cost that you would have paid for your Carlsberg Malaysia shares, right? Now, here's what happened after 10 years. So during this 10 years period, it's not just that you are investing, it's not just you are just putting in money, buying Carlsberg Malaysia shares. Along the way, Carlsberg Malaysia share your Carlsberg Malaysia shares will pay out dividends. So in that 10 years period, I have calculated that the total amount of dividends that you will have collected would be 23,901 ringgit and 70 cents. Okay. The current stock price. So when I prepared this slide, it was the 3rd of July 2025. So the stock price is 19 ringgit and 2 cents. So which means if you take 19 ringgit and 2 cents multiplied by 5,400 shares, the current investment value or the total value of your 5,400 shares will be 103,032 ringgit. Okay, so this is the total investment value. This will be the dividends collected. So I have actually calculated the XIRR, all right, so which is the internal rate of return based on date. In total, you can say that on a per annum basis, you are generating a return, an annual return of 5.89%. Okay. Now, type in the chat box, how many of you are happy to get an annual return of 5.89% after 10 years of investing? This is 5.89% per annum. So it's like, it's compound annual growth rate, 5.89%. How many of you are happy with this return? Type in the chat box. If not happy, just type in not happy. Okay. If you are satisfied, happy, just type in happy. Not happy, say not happy or say no. No. Richie Isaac, no, not happy, not happy, not happy. Okay. Not happy. Thank you so much. All right. Now, to me, here's the thing. Of course, I'm sure that whoever invests in the stock market will not be exactly that happy lah. After 10 years of investing, you kind of like generate 5.89% per annum from your investment in Carlsberg Malaysia, especially after you have invested in this stock, RCA-ing this stock for the past 10 years. Nobody is going to be that happy when you kind of like, at the end of the day, you just get 5.89%. So if you measure it based on this, obviously you're not too happy. But on the other hand, there's another angle to this story. The angle is that after 10 years of investing, let me just rephrase the question. How many of you today would be happy, okay, would be, not to say happy, just satisfied to have 5,400 shares of Carlsberg Malaysia in your portfolio right now? Okay, so which means to say right now, today, if you open up your brokerage account, you see, hey, I have 5,400 Carlsberg Malaysia shares. And that is actually the asset that I own, the stock that I own inside my brokerage account. And you're happy with it, type in the chat box. Let me know if you are happy to see that in your brokerage account as of now, today. So if you're happy, type in happy. If you're not that keen, just type in not that keen. Okay? Let me know in the chat box. But to me, regardless of what, I guess from my own personal view, is this. So let's take a look at the Carlsberg Malaysia. This is from Google Finance. All right, this is the stock price. I guess the reason for Ringgit Cost Averaging, this RCA, is actually this. So imagine most investors, they kind of like, or kononia investors lah. Okay, most people who buy stocks in the stock market, right, they don't tend to look at fundamentals. They tend to look more into the stock price. So imagine you kind of like look at the stock price, which is like this. This is Google Finance. Take a look at this. Here, I'm going to just separate this graph into 3 parts. Okay, 3 parts. Starting from 2015 to right now, to the time where I prepared this slide. So before 2015, it is actually a period where you do not actually do any RCA. This is actually a period where you do RCA. Here we have three parts. So the beauty about RCA is this. Imagine starting from here. If you are just looking at stock price, some people may actually view this as, hey, Carlsberg Malaysia is actually moving up. The price is actually rising. The price is actually appreciating. It's going up higher and higher. So when the stock price is going up higher and higher, what do? Some people may actually question, hey, is this expensive? Is there a bubble forming? Is this not the right time to get in because I'm going to pay a high price for Carlsberg Malaysia? So when you kind of like ask yourself this kind of question, right? What happened is that if you ask yourself this kind of question, you don't tend to buy. Because when stock prices are going up, you tend to think that prices are rising up, it's expensive, so therefore I do not want to buy. Okay, so that's the first part. Now here comes the second part. The second part is actually where we have COVID-19. So the stock price kind of like tumbled. So it not just tumbled, it tumbled quite acutely, quite sharply also it tumbled. So at this stage, there's a lot of fear, there's a lot of uncertainty, and it's because of COVID. When that happens, a lot of people tend to adopt an attitude of wait and see, all right? Since it's COVID-19, things are very murky, things are uncertain, do not know how it's going to look like in the next few years. So let's just hold, just hold, don't invest, just wait and see. So because of this attitude, you also won't buy here. And now the final part, which is this part over here. So at this stage, Carlsberg doesn't seem to go anywhere. So when the stock price doesn't seem to go anywhere, so what do you think? Most people are not excited. I say, hey, Carlsberg is not going anywhere. It's just going up, going down, going up, going down, moving sideways, doing nothing. It's doing nothing, so therefore it is boring. And when it's boring, what do? People don't buy because they will always want to find the next hot thing, right? The next hot thing that will actually rise. So when things are moving sideways, it's not sexy, it's damn boring, people will just ignore it. So at the end of the day, go up, you don't buy because expensive. Crashing down, you also don't buy because you want to wait and see. Going sideways, also you won't buy because it's very boring. So when will you buy? So at the end of the day, if you just base on stock price movements, all right, you try to time the market, you try to find the best time, the best possible time to actually buy certain things. Usually you often end up not buying anything. But however, if let's say you do RCA, although it's not the most perfect strategy in the world, but at the end of the 10 years period, at the very least, that investor who did RCA, right, will still have about 100,000 plus worth of Carlsberg Malaysia shares in his portfolio, and that 5,400 shares in his portfolio, he can estimate, assuming that Carlsberg Malaysia maintains its dividends, he still pay him 5,400 ringgit per annum in dividend income to his account. Okay, so which means to say at least this guy is moving forward in his financial life as compared to someone who is trying to time the market and by trying to time the market, was still not buying anything at the end of the day. Okay, so that is actually the use of RCA. But of course, just now I have mentioned, and just now, of course, many of you have already expressed your opinion. 5.89% is definitely nothing to shout about. But later, I'm going to just share with you two strategies. If you happen to be practicing RCA later, I'm going to share with you that two strategies that might just help you to actually, if you implement it right, you can actually increase or enhance your returns on a per annum basis. Okay? So stay tuned for that. Now, before I get into that two ways, I'm going to just go into the third part of this webinar session by sharing with all of you guys how not to use RCA. Okay? And to do that, I'm going to just share with you, I'm going to just answer this question, which is, can RCA protect us from bad stock investments? Think about it. Now, type in the chat box before I give my answers. Type in the chat box, how many of you think that by doing RCA, you can actually literally protect yourself from making bad stock investments? If you think that RCA can help you, just type in can. If let's say RCA cannot protect you from bad stock investments, just type in cannot. Let's see your response. So Richie Isaac says cannot. So we have Susila Wati says can. Muhammad Azvi says can. Nick Amira says cannot. Mike Cox says cannot. HS Go says cannot. Okay, so I'm going to just answer this debate by giving you another case study. Now, I'm not going to review the name of this stock, okay, because it's also listed on Bursa Malaysia. But let's take a look. So we have stock A. So this is stock A, and this is actually the earnings generated by stock A starting from 2015 to 2024. So stock A, when it comes to earnings, its earnings have actually declined from 910.1 million ringgit all the way down to 721, 492, 468, 346, and down to 183.1 million. Okay, so earnings have declined from 910.1 million to 183.1 million over the 10-year period. Now, assuming that we do RCA on stock A, so which means to say at December 31st, 2015, the stock price of RCA is 56 ringgit and 8 cents. So because you are investing about 10,000, so you run it out, you could buy at that time 200 shares. So 200 shares times this, the exact investment amount will be 11,216. So you make an investment. You repeat the same thing for the next 10 years, and therefore you have invested 99,173 ringgit into this stock, which is stock A, and you have acquired 6,300 shares in stock A, and your average cost is 15 ringgit and 74 cents per share. Okay? This is the amount invested. This is the amount of shares you have accumulated. So the average cost is 15 ringgit and 74 cents. Now, fast forward to the time where I'm preparing this slide. This is what happened to your investment into stock A. 10 years later, the dividends collected 17,112 ringgit and 50 cents. So this is the amount of dividends collected. The current stock price of stock A as of 3rd of July 2025, 4 ringgit and 72 cents. So you take this, you multiply with 6,300 shares. So your total investment value is 29,736 ringgit. How much have you invested? 99,173 ringgit. How much is it worth today? 29,736. So in terms of capital gain, there's no capital gain, definitely a capital loss. So what is your rate of your capital depreciation? What is the rate of return? It's negative 20.58%. All right. So this whole exercise proved one thing. When it comes to RCA or DCA, if you happen to buy a stock that is not actually growing in terms of earnings, doesn't grow its revenue, doesn't grow its operating profit, doesn't grow its earnings, doesn't grow its operating cash flow, I'm sorry to say that RCA is not going to protect you from making poor investment decisions. Let's put it that way. Okay. RCA is not a strategy used to help you to kind of like insulate you from these bad decisions. Okay. So that is actually the answer. The answer to this question, which is, can RCA protect you from bad stock investments? The answer is no. Okay. So in order to use RCA, the first criteria to using RCA effectively is to make sure that the asset that you are purchasing or the asset that you are trying to accumulate must be fundamentally solid. That is actually the first criteria. You must only RCA on stuff that works. RCA on good assets that generate higher income over time. That one you can RCA. What not to RCA is stocks that cannot do that. Okay, so you can only RCA on stocks that generate higher income. All right. Next, I'm gonna just share with you two key strategies that if you are already practicing RCA, you can use this as an enhancer to boost your annual returns. So let's take a look. Now, for my studies, I find that RCA or DCA is quite price focused. All right, price focused, which means to say RCA or DCA is just a strategy based on price. It does not give any consideration to the fundamentals of the asset. So which means when it comes to what kind of asset you want to choose to invest in or choose to RCA, you have to actually do your own due diligence when it comes to the fundamentals, because RCA is just price focus. Okay. So now, as if you happen to be like me lah, practicing value investing, so how can we use RCA? Well, here is the thing. All right. Here's a question that I would like to ask all of you guys. How many of you would invest in a stock that is pretty good fundamentally, but it is overpriced? How many of you want to invest in a fundamentally good stock when the price is is overpriced? So a lot of you guys say no, right? Nobody want to overpay for a good stock. Okay, fantastic. So as value investors, if you are looking at RCA, the first enhancer, the first strategy to enhance RCA is to put a valuation cap when using RCA or DCA. Okay, what do I mean by that? Okay, so here's a few ways that we can actually do, all right, to actually put a cap to the valuation. So here we are going to focus at the fourth point when it comes to the definition of RCA, which is, what do we do when asset price goes up? So when asset price goes up, we don't just blindly just practice RCA and just grab it, because it doesn't make sense. It doesn't make sense to buy a good stock when it is overpriced. So what you do is that we kind of like put a cap, like a maximum acceptable PE ratio. Now over here, because we are doing a back testing, so I'm going to just put a cap. Let's say the maximum acceptable PE ratio that I would like to invest or RCA Carlsberg Malaysia is 23. Okay, so which means to say, if let's say the stock price at that time is valued above PE ratio of 23, I won't buy. If it's below 23, I will buy. Okay, so that's a capping. Here's how it's going to look like. Here is how it's going to look like if, let's say, we are going to put a cap, let's say a PE ratio capping on Carlsberg Malaysia. Here's how it's going to look like. So once again, we have the dates. we have the stock price, and we have the intention to invest 10,000 ringgit every single year. However, the only difference is that every year, before you buy, you calculate its PE ratio. So like 31st December 2015, the stock price is 11 ringgit 70 cents. And you calculated that, hey, the PE ratio of Carlsberg at the time was 16.57. And because it's below 23, so therefore you make the investment, you buy. You do the same thing at 2016. Again, the PE ratio is below 23, so you buy. 21, below 23, buy. 21.71, buy. 30.89, don't buy. Why? Because it's above 23. Okay? 31st December 2020, above 23, don't buy. So as you can see here, you don't buy. 2021, PE ratio is below 23, buy. 22.06, buy. 18, buy. Okay? Now, what happened if you put a capping? When you put a capping, obviously you are going to invest a little bit lesser. So in this case, you invested 79,986 ringgit into Carlsberg. And from it, you acquired 4,700 shares. So your average cost right now is 17 ringgit. Okay, 17 ringgit per share. Now, if you compare it with this, your average cost is a bit lower. At 17 ringgit, it's definitely lower than the average cost of this, which is 18 ringgit 17 cents. So which means by putting a cap on the PE ratio, you're going to buy less Carlsberg Malaysia shares, but at the same time, you're going to reduce your average cost per share from $18 to 17. Now, take a look at the returns. This is how your returns look like after 10 years. So after 10 years, you have collected, or you will collect 21,320 ringgit and 50 cents. So based on the stock price, 19 ringgit and 2 cents, the current investment value would be 89,394 ringgit. Okay. But take a look at the internal rate of return. So instead of 5 point, just now what was the figure? Let's see. So instead of 5.89%, because your average cost per share has lowered, it has been reduced. So your annual returns have actually increased a little bit from 5.89% to 7.48%. Okay. So how many of you can see that this, by doing a little bit of capping when it comes to PE ratio, you kind of like, okay lah, you kind of like increase your annual returns by just a little bit better from 5.89%, right now 7.48%. Okay, so this will be the first enhancer. Let's look at another way you can actually enhance this. Another way you can actually enhance RCA is instead you put a PE ratio, you can also put a capping with dividend yield. All right. So which means to say, instead of saying, okay, I only get, let's say Carlsberg is a dividend stock. Yeah, Carlsberg is a dividend paying stock. So as a dividend investor, maybe what you want is that you kind of like set your own target saying that, okay, for Carlsberg, the minimum acceptable dividend yield that I will accept is 4.5%. So if Carlsberg is paying me less than 4.5%, I won't buy. If Carlsberg is paying me more than 4.5%, I will buy. Let's assume, okay? So this is what will happen. This is what will happen if you happen to put that kind of cap and you do RCA on Carlsberg Malaysia. So this is how it looks like. Take a look. So back in 31st December 2015, stock price is 11 ringgit 70 cents. So at that time, you calculate your dividend yield, it's 6.07%. So because it's above your 4.5% threshold, So here you buy. The next 4 years, the next 3 years you buy because it's above 4.5%. Again, at this time, you don't buy because it's below 4.5%. Over here, you don't buy because it's below 4.5, but every other year you buy because it's above 4.5%. So what happened now is that out of these 10 years, 7 years you buy because it's above 4.5%. And because of that, take a look at the amount of invested capital. The invested capital is 70,834. So from which you acquire 4,300 shares. And then your average cost is now even lower at 16 ringgit and 47 cents per share. Now take a look at the returns. After 10 years, the dividends collected will be 20,588 ringgit and 50 cents. The current investment value, 81,786 ringgit. Your compound annual growth rate, 7.99%. So it's again a little bit better than the 5.89%. So that is actually how value investors, by just putting a capping on your PE ratio or by putting a threshold on your dividend yield, you can actually enhance your returns by a bit. So that's the first step. Now, here I'm going to share with you another enhancing strategy. Let's call it strategy number 2. So just type in the chat box, how many of you would like to sell a stock if you find that the stock that you own is now overpriced? So if you have a stock, fundamentally it's good, but it is super duper overpriced, you will sell it. So if you are one of those people who want to sell, just type in the chat box, let me know whether or not you are interested to sell. Okay, so Yo says yes. HS Go says yes. Lim Kok Chin, yes. All right, thank you so much, TK. Yes, sell. All right, fantastic. So the next strategy that I'm going to share with you is this. It is to actually set your targeted PE ratio when it comes to selling. So selling is not so the selling decision is not like, oh, it's not randomly, it's not random. It's like, oh, today the stock price is good, I'm going to sell my stock. It doesn't happen that way. So a lot of things when it comes to your buying strategy, your selling strategy, a lot of things have been pre-planned, especially with RCA. When it comes to enhancing this kind of strategy, right? You can pre-plan when exactly what kind of PE ratio you want to get in to accumulate these kind of stocks and what kind of PE ratio that you want to get out. So let me just share with you an example on how you can set a targeted PE ratio so that when the stock hits a certain PE ratio, you may want to consider selling. Now over here, let's say this is the game plan. So we have PE ratio 23, PE ratio 28. So if it's below 23, you will either buy or you just, as is shown on the screen, just keep on RCAing, which means you just keep on accumulating if the PE ratio is below 23. If, let's say, the PE ratio is between 23 to 28, you do not buy anymore. You do not do anything. Don't buy anymore. Don't accumulate. Just hold. If, let's say, the PE ratio is 25, just hold. Do nothing. All right? Just do nothing. Hold your shares. But if the PE ratio is above 28, then you consider selling your shares. Okay, so let's say this is actually the game plan. Let's see how it works on Carlsberg, Malaysia. Now take a look. So over here, 31st December 2015, stock price 11 ringgit and 70 cents, PE ratio 16.57. So over here we buy. 20, we buy. 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 Okay. So at this stage, you have accumulated 2,800 shares. At 31st December 2019, the stock price of Carlsberg Malaysia hits 29 ringgit 40 cents. The PE ratio at this point in time, 30.89, above your targeted 28 already. So at this stage, how many of you think that it makes sense to sell? Type in the chat box, let me know. At this stage, at this point in time, 31st December 2019, you think it makes a lot of sense to actually sell the stock? Type in the chat box. Okay, fantastic. Yes, sell, sell, sell. All right, PE ratio very high. It's time to sell. Lepas, all right? So let's say we, at this point in time, back on 31st December 2019, we sell all our shareholdings in Carlsberg Malaysia. We sell. So how much are we going to get back? 86,492 ringgit. So here we kosongkan. Okay. Now, then we move on from here. Okay. So you see you invested this amount, 10 here, 10 here, 10 here, 10 here. But over here you get 86,000. 31st December 2020, PE ratio above 23. So what do? You don't buy anything here. At this stage, you have this amount of cash and no Carlsberg Malaysia shares. Let's move on. 31st December 2021, PE ratio 21.14. Here, you buy. At this stage, 2022, PE ratio 22.06, you buy. PE ratio 18, buy. PE ratio 18, buy. So at the end of the day, you own 1,900 shares. Okay? Now, if you add up all this figure, you have invested this, but then you sold off here to receive this amount of cash. This, you pour in this, you letak balik, you buy back Carlsberg Malaysia shares. Invest. This plus this minus this. At the end of the day, you still kind of like pocketed 2,334. Actually, you did not, your net investment, actually you don't actually have a net investment figure because you still kind of like pocketed in 2,334 ringgit. Okay. But at the end of the day, you still own 1,900 shares in Carlsberg. So what is your average cost? Actually, there's no average cost because there's no investment. There's no net investment based on this example. But after 10 years, what are your returns like? Your dividends collected 9,997 ringgit and 30 cents. What is the value of the 1,900 shares of Carlsberg Malaysia? 36,138. Okay. So do know that you collected this amount of money, your Carlsberg shares worth this amount, and at the same time, you still pocket in 2,334 ringgit. Okay. So all in all, what is your internal rate of return? The internal rate of return after 10 years is 32.68%. Okay. So how many of you are happy with 32.68%? Type in the chat box, let me know. So how many of you are happy? Just type in the chat box, let me know if you're happy. Yeah. Pretty good, huh? Okay, so just keep, let me just see one comment over here. So it says 2,800 shares times 29 ringgit and 40 cents. So it's 28380. Okay, later I will check this amount, then I'll get back to you. All right. But all in all, even this is 82,000, it's still gonna be, it's still, if let's say the calculation is wrong, it's still within the 20 plus range. But I'm sure that all of you guys are actually looking at the picture. All right, so a lot of you guys are happy. Now type in the chat box, how many of you can see that is after this whole backtesting exercise, right? Actually, now do you realize that it's not exactly the stock that you buy, all right? Of course, how many of you can see that different investor can buy the same stock and still get very different returns if despite them investing in the same stock? How many of you can see the difference? If you can see the difference, type in the chat box, say different. It's the same stock, Carlsberg. But why some investors are not getting higher returns? Why some people are getting 5.89%? Some people are getting 7%. Why some people are getting double-digit returns despite investing in the same stock? Different, huh? So as you can see, if you want to generate better returns, all right, there are strategies to actually go about it. RCA is a good strategy. However, it needs to be enhanced. And the two ways that you can actually enhance this is through, number one, you put a capping to your valuation. Okay, this one you can self-determine because different investor will have different ways to determine what is actually the best PE ratio. What's the maximum PE ratio that you want to accept? So sometimes, let's say if you happen to be more conservative, your maximum PE ratio will be much lower. But if let's say you are not so particular, then your maximum PE ratio will be much higher. So how you set it is up to individual's preference. And when you set it right, it will actually influence the outcome of your investment. Okay. But of course, the second strategy is what will be the acceptable PE ratio for you to sell off the stock. So that one you can also set it yourself. So the higher it is, then of course, the less likely you will sell. But if you put it too low, then of course the chances are you're going to sell the stock because your PE ratio is low. Now, Mike Cock, you have a question, says, why need to wait till the end of the year again? Well, because this is a backtesting lah. So backtesting means to say you are just being a robot. You're being a robot, you're trying to buy the stock at 31st December. So why 31st December? Because it is easier for me to actually construct a case study like this using the closing stock price of every single year. So it's actually out of the simplicity of coming up with this case study. That's why it is presented that way. But of course, like I said, RCA, right? You can do it not just 1 year once. You can do it every 6 months once, every 3 months once, or every month. If you have the money, you can always do DCA. So even that itself will actually impact your whole investment portfolio. So there's no need to wait. It's all up to us to decide how frequent you want to actually invest in a certain asset. Now, here are some key takeaways. Of course, later on, I would like to discuss with you on the questions and all this while I look back at my own calculation. Here are some key takeaways that I would like to impart to you guys from this webinar session. Number one, DCA or RCA, it is actually a strategy meant for value investors to accumulate, all right? It's an accumulation strategy, long-term accumulation strategy to build a bigger portfolio. So it's actually not for trading because it's not meant that way, all right? It is actually meant to accumulate over time. DCA cannot protect us from bad investments. So which means to say, if you want to do DCA or RCA, make sure that whatever you are investing, the fundamentals are intact. Now, DCA is also a price-focused strategy. So which means to say they don't really consider valuation. So if you happen to practice value investing plus RCA, make sure you incorporate the valuation tools. And this one you can self-determine what's your preferred PE ratio to go in and what's your preferred PE ratio to get out. So you you can actually set all these things. And last but not least, you can always use a range in valuation tools like just now what I've mentioned, the minimum, the maximum PE ratio, or you can actually use this with dividend yields. No issues on that. Okay, so with that, I'm going to just pass back the control to Ativa, and I would love to interact with you guys on Q&As that you might have.
Okay, thank you, Mr. Yen.
Mm-hmm.
So I would like to thank to you for that eye-opening and insightful session. Now we'll move on to our Q&A session. If you guys have any question for Mr. Yin, you guys can type their question in the Q&A box and I'll read them out and we get through as much as we can. Okay, should I go for the first question?
Yeah, sure.
Okay. The first one is, does bank stock consider good for RCA?
Bank stock. No, it's not so much about bank stock, or it's not so much about what stock, because bank stock also got good and bad one. So the key criteria is not so much about what sector. The key criteria is what kind of business that you want to own. Is the business that you want to own the kind that generates consistent growth in revenue, consistent growth in profits, consistent growth in operating cash flow? So if the if the business that you want to DCA or RCA is actually pretty good a business, it doesn't matter whether it's a bank, a REIT, a technology stock, consumer products, industrial products, doesn't matter what. As long as it fulfills the financial criteria, the financial returns are good, then why not?
Okay, for the next question is, how do you set max PE ratio for DCA based on company past performance or industry benchmarks?
Okay, so that one it depends on how you look at the certain stock. So for me, I like to actually calculate what exactly is the past PE ratio, past historical PE ratio of a certain stock for the past 10 years. Okay, so let's say I roughly know that the range is actually between, let's just say 15 to 20. On average, is about 18. Okay. So, which means to say, I will actually, I will actually want to buy the stock, hopefully lah, at the PE ratio below 18. So I'll just DCA or I'll just do RCA as long as the stock continues to, as long as the stock continues to trade at the PE ratio below 18, and I like the stock, then I will grab. But if let's say the PE ratio is above 18, let's say 25, then maybe I'll find another stock to DCA lah.
Okay, the third question is, the challenging decision is how do we calculate or decide the acceptable PE or dividend yield to RCA, not to RCA, or to sell the stock, any basis or guideline to follow?
There's no hard and fast rule lah, but like I said, the first criteria lah, because at the end of the day, the wealth of the stock comes from the business earnings. So you want the business earnings to keep on growing. That's the first criteria lah. If the stock, the earnings is not predictable, the stock earnings is actually declining, or worse, you kind of like a stock that is incurring losses year after year one. I do not know why, but if you are a value investor, you don't I? I mean, they say it's unthinkable for a value investor to buy a stock that keeps on losing money every single year lah. Very unthinkable. So let's assume that you get that aside. It's just a stock that just keeps on increasing its profits year after year and all this kind of stuff. So you want to actually find the PE ratio, the median PE ratio of that stock for the past 10 years. So that is actually the basis already. Okay, that's already the basis. Now there's another basis that you can actually go with. So let me just say, okay, now let's say you are buying a stock. Okay, even without that basis, put it this way. Let's say you have a stock that is earning 1 ringgit in earnings per share, and the price is 50 ringgit. So you are paying 50 ringgit to buy a business that is earning 1 ringgit per share. all right? So that's PE ratio of 50. So if you reverse it, it's like you invest 50 ringgit, but what's your earning? 1 ringgit. So 1 divided by 50, what's your earnings yield like? 2%. So if your earnings yield is 2%, then is it very attractive to you? At least it's not attractive to me. So if you put it this way, if there's another stock, fundamental quality is there, the price is 20, the earnings per share 1. So it's like 1 divided by 20, the earnings yield is about 5%. So I think 5% is actually more acceptable than 2% lah. So because of that basis, then I'll say, okay, look, that is actually the range that I will go with lah. The 5% mark will be, the 5% earnings yield will be much better than 2% lah.
Okay, and for the next question is, in your POV,
Uh-huh.
which type of stock can be rewarding using this RCA strategy? Whether potential growth stock or mature dividend paying stock?
Sorry, the two stocks again.
Whether potential growth stock or mature dividend paying stock?
Um, like I said, it all comes back to the financial statements lah. All right. What is potential growth stock? So how does it look like in terms of its financial performance? So if the potential growth stock is the one, what exactly is the definition of a potential growth stock? Because there are many definitions of potential growth stock. Some people say potential growth stock is a stock that is about to fly to the moon. That one is potential, ada potensi untuk terbang. So if let's say that is how you think, then no lah. All right, then that's not the whole purpose of RCA lah. Okay, because RCA, it takes a long time for you to
Then,
actually, a long time for you to accumulate lah. It's not to say you don't see immediate results, but RCA, the purpose is that at the end, it's not so much about what's my returns at the end. It's like after 10 years of investing, what's my end game? Uh, so it's not like how much, okay, so I'm going to buy a stock at $1 and then how much can I sell it for over the next 6 months or over the next 12 months? That's not the whole question. It's like, if let's say I want to buy a certain bank stock, okay, let's say I'm interested in a certain bank stock. So at the end of 10 years, how many of this bank stock I have accumulated in my portfolio? So now that's a whole different question. So it's like, oh, I have 100,000 shares in that bank stock. Can you retire with the 100,000 shares of that bank, right? You see that in your brokerage account. Can you retire with that? Then that is actually the more appropriate question lah to ask for when it comes to RCA.
okay. The next one is for banking stock. What
Uh-huh.
PE and dividend yield is good level to do the RCA cap?
For what bank stock?
Mhm.
Mm, that one, it depends on which bank, because even like banking stock, Maybank and public bank, different what? Public bank versus
Yeah.
RHB, also different. Uh, so it's not exactly, so even when it comes to that, then you have to like see which bank. But within the sector, I don't think the PE ratio for all the bank stocks right now and the dividend yields, they are pretty similar, more or less. All right. So as long as you don't go too far away from what everyone else is trading, then fair enough. Okay, let's say for example, the range is around, let's say the range between all these people lah. All right, let's say the PE ratio is around 10, for example. And then in general, they are giving around 5% in dividend yield. Okay, so you don't go too far away from this median lah. So you don't suddenly buy a bank stock when the PE ratio is at 30, for example, because wait, 30 is an outlier as compared to what most of the people are trading right now, which is around maybe 10 or something like that. Then you just build a portfolio based on that lah. Ah,
Okay, the
mm.
next one is a market is down 30% and market sentiment is highly negative. Should you accelerate your RCA or hold your regular pace and why?
Ah, because it's not the question is actually on trading, right?
Mhm.
Market volatility, right? So it's because of market volatility, you want to get that out of the system. That's why you do RCA. That's why you just be a mechanical robot. You kind of like, I preset, I don't want to think too much what the market looks like. Every 3 months, I'm going to buy a certain stock because the certain stock I believe is good. Just buy, 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 buy. Like let's say every 3 months once, I'm going to buy that stock. Let's say stock A, for example. Not the one that I show you on the presentation slide. I'm just giving an example, all right? Let's say you found a stock, the stock is good, and it happens to be stock A. So every 3 months once on 31st March, 30th June, 30th September, I don't care what the market looks like. I don't care what Donald Trump is going to do. I don't care who is running this country. I don't care what Bank Negara says, oil palm. I don't give two hoots about anything. It's not part of my consideration. I just buy, 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 buy. Okay, time's up, buy, time's up, buy, time's up, buy, time's up, buy. Repeat that for 5, 10 years. Suddenly your portfolio has X amount of shares of that particular stock that you like. Then that is actually the whole intention of RCA.
Okay, the next question is with market condition being so volatile lately, how
Uh-huh.
realistic is it for traders to rely on RCA for consistent improvement?
Oh, traders won't use RCA because traders are in for short-term profit. So if you are in for short-term profit, you won't actually do RCA. It's just not possible. Okay, because traders have a different mindset, they have a different game plan as compared to the rest of the people. So if you are looking at trading, then it's a totally a different thing. But since I'm not a trader, I'm just an accumulator, then I just happen to be the wrong person to ask this question because my whole strategy is very simple. Just find some good businesses and just buy, try not to overpay, and just do nothing else. Just enjoy your life after that.
Okay, the next one is what are the pros and cons of weekly versus monthly RCA contributions?
Oh, actually, mm, there is not much of a difference, I guess. The question is, if you want to do weekly RCA, it means that you have a lot of capital to in RCA lah. So it's like, wow, you have a lot of bullet, and then you just buy a bit. Every month you can buy something, right? Or every week you can buy something. And first, if you happen to do that, congratulations. That's a that's a wonderful thing. But in terms of investment performance, of course, it depends on the quantity and the quantity of shares at the end you buy, whether or not is it a meaningful quantity, and what sort of PE ratio that you buy into it lah. But ultimately, at the end, I don't think it's gonna be that much of a difference. I haven't done the calculation, but suffice to say lah, the the number one key determining factor lah that will generate investors wealth is at the end of the day the fundamental of the business is the profits of the business that matters. Now, Ativa, can I share with you my
Oh,
screen?
you want to share? Okay, okay.
Yes, because I just want to share with you how the whole case study came about lah. What sort of work I have done, the
Okay.
spreadsheet lah. I just want to share with you guys something
I,
really cool over here lah, which makes me a nerd lah. But then the thing is that I- this is actually how it's all calculated lah. So this is actually the whole calculation, and this is how I get the whole XIRR calculated lah for each and every single case study. For each and every single case study. Uh, so there's a lot of there's a lot of trailing lah, like the dates on when the dividends are being paid, how much I have to calculate lah. So all these things are there lah. But I just want to actually look through one uh because there was a comment, so I just want to like tally nicely. So I'm gonna just make one pembetulan over here lah. Yeah. So I guess over here that is a pembetulan. Okay. Okay. So no issues, no issues. All correct already. All right, all right. So any more questions, Ativa?
there is the first type is the hardest one. How to pick a good grade stock to backtest?
Oh, the simplest thing is actually just to focus on the uh just look at annual reports. Like just now the back testing like Carlsberg, right? Uh, So just find another stock to beat that beats Carlsberg lah. All right. This is just that I'm not saying Carlsberg, by the way, is not the best stock in the world lah. But then the thing is that at least you can see that the earnings are actually growing, right? And by the way, if you happen to be, let's say you happen to be an investor who wants to uphold, let's say, the Sharia kind of principle, and you're not into Carlsberg or Heineken and all this stuff, no worries. It is applicable. Just find a Sharia compliant stock where the earnings are also like that lah. All right, also increasing every single year, and you know that it's a business that is generating good income, more and more income in the future,
Mhm.
and just apply the same principle on that stock lah. It's just that lah. So the whole criteria revolves around earnings and cash flow.
Okay, the next question I will read is uh can you recommend any books that to learn this DCA strategy in depth?
Oh, should I announce? Because because I do I think that is a bit premature, but because I'm also interested in publishing a book on that. So if anything, I will let you know in a few months' time. Maybe it's my book, but it hasn't come out yet. Uh, although it's in the pipeline lah. It's in the pipeline with the publisher at this time lah. All right. But I would say books to recommend. But if you want free resources, right, the best material would be, Berkshire Hathaway, the company, the Warren Buffett company. Berkshire Hathaway has its annual reports, and Warren Buffett, the great investor, he will write all his cerita lah on the performance of his business and all this. But in between, right, it has a lot of gems of wisdom when it comes to investing. So if you read Buffett's letters, then that will be high quality education lah. But if you want books, Buffettology is a good place to start.
Okay, maybe
Mm.
this is the last question that I will read is how does RCA performance compare when applied to defensive sector versus cyclical sectors?
Okay, I presume that defensive simply means to say you buy certain things that you know that even the economic collapse, the whole country still requires that product, right? So that's called a defensive sector, right? Which means the stock market can tank, but the whole world still buy that product. That's called defensive, right? So that one, yes, it can work. Cyclical means to say economy good, maybe you buy, economy bad, maybe you don't buy, or maybe you produce a commoditized product, like for example, let's say let's say crude oil lah, all right? Let's say you
Yes.
are a company that produces crude oil, and then crude oil price go up, so your sales go up. Crude oil price depressed, then your sales kind of like depressed. Then of course the defensive one will do better than cyclical lah, because RCA is not for everything. RCA is just for companies that are pretty stable, companies companies that they don't actually do anything stupid. They just they're just consistent performers. They just profitable, highly profitable,
Yeah.
and increasingly profitable. That kind of businesses are only that kind of businesses are suitable for RCA lah. If you want to buy cyclical, that's another that I think some other people they profit from that, but not me lah, because I'm not well versed with that strategy lah. Mm.
Okay, I think that is the last question. So once again, I want to thank you for Mr. Ian taking the time to answer all those great questions. And to all of you, thank you so much for actively participating. I hope you have gained some new ideas or perspective that can help you in your investment journey. Uh,